connecting investors, financial institutions, and businesses around the world. Luxembourg is a centre of excellence for global finance. Recognised for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial centre and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Welcome to our Focus on 2025 conference. My name is Théobald. I'm the CEO of Luxembourg for Finance, the agency for the development of the financial center. Over the next hour, we will look ahead and chat with three experts who will give us their insights into what financial markets and the financial sector can expect in the coming year. In a few short weeks, the year 2024 will come to an end. It was a very eventful year. It was a year that was deeply marked by wars and conflicts raging in different parts of the world, including the war in Ukraine and the crisis in the Middle East. It was also the biggest election year in human history, with more than 3.7 billion people going to the urns in over 70 countries, including in India, the world's largest democracy. EU elections in June also brought change in Europe. Last week, a new EU Commission second von der Leyen Commission with new faces took up office in the world's largest trading bloc. And in November, US elections paved the way for a second Trump term. And as a new US administration is in the starting blocks to take over the reins of the world's leading economy, we are of course all closely watching any indications that come out of the US in terms of policy or direction of future policies, including and especially when it comes to trade. Economically, 2024 was equally transformative. The global financial sector faced a dynamic year with shifting interest rate, a booming crypto market, and ongoing debates on Basel implementation, amongst others. While some regions saw remarkable recoveries, others grappled with inflationary pressures and growing demands for fiscal responsibility. Looking ahead, 2025 promises to be a year of both possibility and dangers. Productivity and global growth will, of course, remain key focal points. Key areas to watch include the intersection of sustainability and technology, the continued evolution of artificial intelligence, and the urgent need for action on climate change. Additionally, geopolitical developments and their influence on global markets will require close attention. This year's Focus On event thus couldn't be more timely. I very much look forward to hearing from our three special guests this morning. First, we will have an outlook on the global economy and the global economic environment, especially with a new US administration coming in. We will look at what to expect on the EU regulatory front from a new commission. Finally, after a year of a certain backlash against ESG, we will ask what 2025 will bring for ESG investments. Let me also thank our sponsors for making this event possible, Atos and the Luxembourg Stock Exchange. And now I have the great pleasure of talking to Tannenbaum, Chief Economist of Northern Trust. Good morning, Carl. It's a pleasure to have you with us today.
It's good to be with you too, Tom.
Thanks for joining us. In my intro, I said that 2024 was a very eventful year. Looking at the end of the year, I think we can expect that 2025 will be no less eventful. And it will also probably come as no surprise to you that top of the list of topics that an audience would expect me to ask of a leading US economist is on trade. So let's get right into the thick of it. We have a second Trump administration that will take office in a bit more than a month time. We've seen a lot of, on the campaign trail, a lot of discussions around trade policy, tariffs, America first. What can we expect and what should international markets prepare for in the new Trump administration?
Tom, on the campaign trail, Donald Trump said that tariff is his favorite word in the dictionary. And he does seem to be turning to that page very often as he issues a series of threats of tariffs against various countries. The tariffs in some cases are designed to address what are perceived inequities in trading relations. They're also being used to get attention to non-economic issues like immigration and drug interdiction in the case of Mexico. I think what the world should certainly expect is that there will be a lot of threats. There were a lot of them during the first Trump administration, but importantly, not all of those threats come to fruition. Tariff threats are often the first step in a bargaining process, which can then begin to go through the specific issues related to trade, and they often end at a level that is far less extreme than threatened at the outset. Certainly, an example is the redo of the North American Free Trade Agreement under the first Trump administration. There were a lot of extremes thrown out there, but in the end, the updated agreement was not that different from the one prior. The other thing I would point out is that there are a mix of issues that the United States has, of course, with Europe and other parts of the world, and economic exchanges are only one of them. The mix of things that will come onto the conversations surrounding tariffs, I am hoping, will lead to solutions that are mutually beneficial. Now, I do want to make one caution, that is that many analysts that I've spoken to are assuming that the threats will dissolve and that the reality will be smaller. And just for our audiences here in Europe, the Trump administration is counting on some additional tariff revenue to fill holes in the budget. They'd like to cut taxes a little bit further, and they're under some constraints to not increase the American deficit. So they will need some additional revenue, and some incoming members of the administration are hoping that tariffs will fill those gaps.
Thank you, Carl. That's an interesting point. I think from the, I want to come back to the deficit and the debt levels. Maybe just a quick follow-up question, if you don't mind. How do you see Europe in this global context with the U.S. administration, potential global tensions that we've seen over the recent years between the two superpowers? I would be interested to get your quick view on that as well.
I don't think I'm speaking out of school in observing that the first Trump administration was a difficult one for the United States relations with Europe. Someone sent me a photo of a G7 meeting where Mr. Trump is sitting with his arms folded and other European leaders around the table, including Angela Merkel, looking exasperated. The upside of this, Tom, is I think Europe will not be surprised at all by Mr. Trump's approach to things. I was actually encouraged that Emmanuel Macron had invited Mr. Trump to the reopening of Notre Dame over the last weekend. It was at least a gesture to recognize the way that things might operate and an effort to get out in front of some of the negative things that are captured by the television cameras. At the end of the day, Tom, Europe and the United States are united in the efforts to maintain security in this part of the world. The United States is going to be asking more of the Europeans to maybe push harder against China, which is the #1 target of the trade sanctions that Washington is thinking of doing. And one cannot create adversarial relations with your allies as you're trying to address perhaps a common opponent. So perhaps I'm more hopeful than realistic, but I think the second time around might be a little bit more collaborative than Trump 1.0.
Thank you. It's good to hear that you have this optimistic view. I think you're absolutely right. We need this international collaboration on another topic where I think internationally we've seen a lot of developments is the level of debt, the unprecedented level of public debt that we've seen globally. In Europe, of course, we've had a double whammy of COVID followed by the energy crisis, which has, of course, put strains on national coffers. How do you see let's say, the global level of debt? What's your view on the impact going ahead on the global economy, but also what measures the US administration will potentially take to lower that level of debt and deficit? What the impacts could there be on the rest of the global economy?
Well, Tom, it's fair to say that debt around the world has mushroomed, first as a response to the 2008 financial crisis, and then in Europe you had the second leg of the sovereign debt crisis, and then COVID required government outlays in order to keep the economy from falling too far. That has doubled, or in some cases tripled, the level of national debt relative to GDP. And certainly in the core of Europe, that has created great levels of discomfort. As we visit, I believe there are 7 countries that are under excessive deficit procedures to try and get their fiscal houses in better order. One of them, France, had as an ingredient in its the collapse of the Assemblée, the challenges of trying to get all of the budget elements in line to the satisfaction of both the French public as well as the Europeans. I think that is a scene that is going to be repeated frequently across the continent of Europe. And once again, the debate between austerity and leaving some room open for long-term investment in energy transition, security, and social well-being, I think are ones that, and climate, I think are ones that are going to be very, very difficult. Another element, Tom, that we have in common between the United States and Europe is that the politics are quite polarized. The middle has been shrinking and the extremes have been growing. And when you have a dynamic like that, the compromise that is essential to address long-term economic problems gets more difficult to form. Now, the main difference between the United States and Europe in this regard is that whereas Europe either has legislative or collaborative limits on debt and deficit, the debt brake in Germany, the informal arrangement that the Parliament has here in the United Kingdom, where I'm speaking to you from today, we don't have really that same feature in the United States. We have a debt ceiling that we have control over and we increase. But I think another theme that we need to watch out from a market perspective is that investors are getting impatient with the persistent layering of debt by sovereigns. And so it's not a surprise as we visit that French bond spreads relative to Germany are at their highest level in 10 years. Another angle on that, Tom, you may have seen, is that it's costing France more to borrow than Greece at the moment, which I never would have foreseen. And for the United States, as the new administration comes in and decides to cut taxes and spend more, whatever limits that there are in the United States, and there are some, ultimately the markets are going to be the judge of whether the debt is sustainable. And event risks like we had with the trust budget here in the United Kingdom in 2022, as well as other market events where debtors have expressed displeasure, we may see those more frequently in the years ahead.
Thank you, Carl. We briefly touched also on the geopolitical dimension, and of course one of the big concerns that we are seeing, of course, is that that there's a number of wars still going on, especially the one in Ukraine, which is still raging, and of course has implications on defense and defense spending, and of course the question is how will these geopolitical tensions in the mid to long term also impact the what are the implications for global investments?
First, some root causes. Ever since the 2008 financial crisis, Tom, the data show us that countries have been growing a little further apart economically. The history of trade frictions, tariffs, quotas, domestic content has been traveling a direction that looks like this since really 2009. And associated with that, the measures of geopolitical risk and uncertainty have been doing the same thing. So the global order that existed before the GFC, both economically and diplomatically, has gone into something of reverse. And it's tragic, the wars that are going on today and the circumstances surrounding the two that you've mentioned go back decades, if not centuries in some cases. But the fact that they're happening now, I would attribute in part to the challenge that countries have in the current day of coming together to perform diplomatic function. It creates tail risks all over the world because where large countries step away, bad actors can step in. Even as we visit today, Tom, as you know, Syria was taken over essentially in a little bit more than a week. And that creates another round of uncertainty, similar to what we saw in the Arab Spring 13 years ago. We could see other situations like that, which really require careful review by investors. What I would offer, Tom, is at least what we're trying to do here at Northern Trust is, as much as we would prefer not to do this, we do a lot of tail event planning. We create a scenario where something falls out of line, and we try and think about what that will do to markets, what will that do to sovereigns, what knock-ons will occur after the first shock. I would recommend that portfolio managers just be aware of how those things may play out, and to the degree that they can take out insurance policies with their portfolio construction, they deserve careful consideration.
And in that context, and we've discussed, debt levels, etc. How do you see countries balancing that kind of call for fiscal responsibility on the one hand, and then of course in this current global context, the need for increased defense spending, essentially?
That is a very good question that all countries are having to answer. My own view is that budget rigidity is probably not well advised. Of course, the debt levels are uncomfortable, but is now the time, especially in the area of security, which if lost, then what else is there, I would ask rhetorically, is now the time to be constrained in your ability to defend borders against adversaries or to head off crises before they reach your perimeter. That is, I think, a very challenging question for those in fiscal authority. Of course, Tom, if you hold security sacred and try and focus your budget attention on other things, then the pressure on energy transition, technological modernization, even pensions, with the demographics that I know we want to talk about in a moment here, how do you find the economies that would allow you to continue to spend on national security? It's a very difficult challenge.
Thank you. Yeah, you mentioned it. I think one of the topics we wanted to discuss indeed is this demographic challenge with an aging population. I was just in Japan recently, where there's a renewed push to mobilize savings into investments to address that challenge. But it's a problem we see all over the world, including, of course, in Europe. So what's your view on this, and especially what are some of the solutions to address this?
I usually get very touchy when people bring up aging demographics because I think they're talking about me. I'd like to think I'm still young at heart and vigorous, but the gray hair isn't fooling anybody. Of course, I'm not atypical. I'm a member of the tag end of the post-war generation in the United States, and there are cohorts like that all over the world as they move into a well-deserved retirement in some cases. The fact is that older countries have more challenges with pension and health systems. Older countries statistically are granted fewer new patents, fewer new businesses are formed, entrepreneurship goes down, the willingness to make long-term investments obviously is curtailed as time horizons have shrunk. And so trying to stay collectively youthful is something that's very important for all cultures. One of the basic things one learns in economics is that the richer a country gets, the fewer children it has. And we've seen birth rates obviously falling precipitously in Europe. There are some European countries, Italy comes to mind, where the birth rate is below what we refer to as the replacement level. In the United States, we're just barely keeping pace. So if you're going to sustain your economic vitality, there are two strategies you have to think about. One is immigration, which is a problematic issue all over the world. After closing the borders to safeguard public health, countries reopened them to experience, in many cases, an absolute surge of immigration. Canada, the UK, the United States, Australia, New Zealand, just to name a handful, had near record increases in their populations in 2023. And those flows, Tom, are seen by many as too large, difficult to assimilate, not consistent with long-term economic prosperity. And of course, there are the social and ethic issues that come along with that. I think that 0 is the wrong number for immigration, but gauging that properly is something that I know a lot of countries are thinking about. I would also add that for Europe, the fact that you have wars and oppressive regimes and climate change that are driving people closer to your shores, the immigration issues that were so poignant just, 8 years ago in Europe are likely to recur. And if the continent doesn't come together and understand how they want to deal with all of this, you could have humanitarian challenges in a lot of countries. The second avenue to remaining vital is through productivity, and that's where all of the emphasis on artificial intelligence and analytics are coming very much to the fore. The potential there to improve productivity is significant, but the path could be bumpy. How do you safeguard privacy and data security as you're trying to use these routines? Sometimes the models don't work very well. Sometimes they can be used for ill as well as good. And what happens if there is displacement of people as a result of AI before they're ready to transition into retirement? Society has dealt with these kinds of technological transformations before, and we can learn some lessons. But while I'm excited about AI, we do need to manage its progression very, very carefully.
Thank you, Carl. Since I have you here, let me just take this moment also to ask you a question also on behalf of our audience. I think we covered quite a lot of topics, but if you had to pick a couple of upside and downside risks that really could surprise the global economy in 2025, what are you thinking of?
Tom, I'm a risk manager, so unfortunately, downsides are the thing that I think about most. I think if you believe that there was a lot of value in globalization in terms of collaboration and holding down prices and the like, economic development for smaller countries, the fact that we're moving in the opposite direction should worry us a little bit. I mean that on a global scale and even here within Europe. Now, on the upside, mankind has forded a lot of rivers that seemed impassable before. And I think whether it's scientists or diplomats are already working on solutions to many of the issues that we've touched on today. I think the clarity around those issues is not being debated as much anymore. So we have a clear sense of purpose. The question is whether we can bring symmetry to the political perspectives and then the economic perspectives, which seems so hard to achieve. In the long term, nobody is served by a lack of compromise and on the politics of just trying to get to the next election and get one additional seat. Long-term challenges require long-term solutions and a long-term vision on the part of those who represent us. So we've achieved that before, and I'm hopeful that the gravity of the situations that we've discussed today will prompt the kind of action that will put our economies and our societies on strong footing for decades to come.
Thank you, Carl. I think that's a perfect moment to conclude. I think we're just in time. A hopeful message as well. I think before these, as we head into Christmas, again, it's a great pleasure as always to talk to you. And thanks again for joining us, Carl.
Mon plaisir.
Merci. So now I have the pleasure of handing over to my colleague Benoît Theunissen, who will interview Anke Klein, Managing Director of the Investment Company Institute's Brussels office, and they will talk about the upcoming EU regulatory agenda. Benoît, over to you.
Thank you, Tom. Good morning, everybody. I am Benoît Theunissen. I am a policy and regulatory advisor with Luxembourg for Finance. I am now in the studio with Anke Klein. Good morning, Anke.
Good morning.
We will discuss for the next few minutes on the topic, which is new bottle, old wine. What does the new EU Commission have in store on the financial services regulatory front? Anke, to introduce you to the people watching us, you are the managing director in the Brussels office of the Investment Company Institute in Brussels, which is a global association of regulated funds. You have over 20 years of experience in financial services policy. You have served as financial attaché for the Netherlands EU permanent representation, leading, among others, negotiations during the Dutch EU presidency. You have also been a program manager at the Dutch Central Bank, just to name a few roles in your very remarkable career. So, first of all, Anke, I would like to start with the future expansion of the EU rulebook. We know that over 42 legislative acts were introduced between 2019 and 2023. And we saw that the EU has significantly expanded its financial regulatory framework. And in your opinion, I would like to know, will this momentum continue, or will there be a shift towards regulatory consolidation and simplification with this new Commission?
Yeah, thank you, Benoît. And first of all, thank you so much for having me. Yeah, it's actually a great question, because I think if you look at competitiveness and burden reduction being so high on the political agenda, it would actually be contradictory to further expand that regulatory rulebook in the way it has been done in recent years. And I think if you also look at the statement from Ursula von der Leyen, that she wants to use a competitiveness compass, not only, of course, for financial services, but for the whole Commission and in general, I think that already shows that there will indeed be a difference. And I would say that the focus, to answer that question, indeed, that the focus will much more be on implementation and also on simplification. But having said that, it is, of course, also quite difficult to change things without adding new rules, because very often you need a new proposal to change the previous ones. With one exception, the Commission has the power to reduce burdens in proposals which are not yet finalized. And Benoît, if you would be interested, I can also give you a quick update on the proposals we actually are already expecting from the new Commission, because the Savings and Investments Union is, of course, one of the major topics for the new Commissioner Advocay. And what we're hearing is that she will indeed propose a roadmap or a action plan. I mean, the name is probably not final yet, but with new steps on the Savings and Investments Union. And we're expecting that in March from next year. And there are also 5 reviews we've been hearing about. The first is the CSDR, so the Central Securities Depositories Regulation. You probably already recognize that that is about T+1, because it says no longer than 2 days, and that is, of course, is then 1 day. We're expecting that in March, April. There is, of course, also the consultation on securitizations going about. Actually, that was just finished, but we are expecting a proposal there in June. And also on the SFDR, the Sustainable Finance Disclosure Regulation, that's expected for June, July. The money market funds review, that is expected after the first quarter. And the last one I would like to mention is the omnibus proposal. And that is actually aimed at reducing burdens. And it was indeed von der Leyen herself who mentioned examples like CSDR, CSDDD, and taxonomy. So as you can see, there are, I mean, of course, there are the ideas of maybe making things simpler, but it also depends a bit on how the process then goes. Because if the proposals are there, then of course in the council and in the parliament, the co-legislators can also come up with ideas they have on that same topic.
Yeah. Thank you for summarizing all this retro planning of different revisions that we should expect next year. Speaking about that, as many frameworks, as you said, are under review, the challenge lies in balancing detailed rules with a more flexible, or what we can say, principle-based approach. And having that in mind, how can the EU address the specific difficulties posed by its supranational structure compared to what we can see in the US or in the UK?
Yeah, that supranational structure is indeed quite unique and also complex. And yeah, we call that united in diversity, right? But that indeed means that regulators really need to coordinate and communicate to make sure that there is consistency in all 27 member states. And I think on top of the supranational structure, there are, of course, also cultural differences in who, for example, prefers the more rule-based approach or the more principle-based approach. And I think that is not only between member states or between regulators, but that is actually also sometimes in the industry that bigger organizations tend to prefer the principle-based rules and smaller organizations tend to prefer the rule-based rules because they don't have the bandwidth to then translate them for their own organization. So I think it's very relevant to be aware of these things, both when new files are being negotiated, but definitely also when rules are being applied, because it's of course something which always plays a role. And in our view, it's actually not either or. What we need is an appropriately tailored regulatory framework. And at the moment, it is a little bit too much rule-based in our view. But like I said, good communication is a solution for that. And let me add one more thing, because supervisory convergence and the role of data is, I think, very important in this part. Because and let's also then maybe already immediately say that supervisory convergence is, of course, also something really different from a single supervisor. But when we speak about this supervisory convergence, it is really important that regulators can share the data they have. And I think maybe even that there would be good to have a discussion on maybe that they could use the data for more than the one thing they got it for. And of course, you need to make sure that that is all done in a proper way. But by sharing more data, of course, also regulators can inform each other better and can also look at vulnerabilities or risks. And that could be really a meaningful step forward. And what we see indeed is that the Commission is also planning to simplify and streamline things and reducing these unnecessary regulatory burdens. That is, of course, something we really welcome, and that would also be very beneficial for growth and investments.
Yeah, this is indeed really important, especially the supervisory conversion that you mentioned. Earlier in the discussion, you mentioned also the capital market union. It's very strategic for the future, but now we are also speaking about the savings and investment union, seeking to integrate banking and capital markets, using, on the one hand, financing, private financing and also public financing for key projects such as climate transition or defense. In your opinion, is this shift from public to private funding achievable, and how will it benefit the EU's financial ecosystem?
Yeah, and I think indeed, I mean, I think it's really good also to have the savings and investments union now. I mean, it is of course also a new word for something we maybe already knew. But I think it's very useful that we can indeed use the momentum. And the vibrant capital markets, which are of course part of both, they are really essential to the success of the EU project. If you look at the higher rates of return people get, if you compare that with, for example, what you get for savings in your bank account, and also the fact that people can then indeed really have a wealth creation which is bigger than otherwise. And the capital markets, they channel, of course, also capital into these European companies, and they support long-term investments. So that is why I think indeed that these vibrant capital markets are really, really necessary. It's of course also in the mission letter of Albuquerque that she needs to unlock these private investments. But I think it's also fair to say that that shift will not be something which you can achieve overnight. It's a big change, I think, because it's also a cultural change in the sense that people are maybe now more used to saving. And with all things which are big, even if it takes long, you better start now, because the longer you wait, the longer it of course also takes to achieve the thing you're working on.
That's very important. And as we are speaking about integrating further financial markets into the single market, we should maybe avoid an inward-looking or a protectionist stance. Indeed, the single market must remain open and competitive, especially because we need to attract not only capitals from inside the EU, but also from outside of the European Union. So, what do you think? How can the Capital Market Union initiatives avoid being perceived as what we can say EU-gazing and ensure a balance between European autonomy and, on the other hand, openness to global markets?
Yeah, that is a very, very good question again. I mean, what immediately pops up in my head is the whole cake is bigger if you give everyone a bit, because I think it is always really important to, first of all, look at the citizens in Europe, the companies in Europe, and I'm indeed afraid that protectionism would definitely be too short-sighted, and that European households, they of course benefit from these vibrant capital markets, and markets are global, and that's the same for companies. They of course also want to use the whole world out there, and I think it is indeed relevant to also then look at the facts basically, and not to be afraid, and also to work on the competitiveness, and in that way you can also become more stronger.
Yeah, you mentioned earlier in the discussion the T+1 settlement cycle. And I would like now with you take a global perspective on what's happening in Europe. How do you think is the European Union prepared for this shift, and what are the challenges? I'm thinking about maybe systems upgrades and market readiness that might need to be addressed to implement T+1 across a market that is fragmented like in the European Union.
Yes, yeah, that T+1 is indeed something where you also see what we were talking about in earlier on, that the complexity of the amount of regulators, for example, or in this case the amount of CSDs makes it more complex. But I think first of all it's really positive that ESMA proposed the date, so that's October 2027. And it's very important to have that date set. And now indeed the hard work can start. And I will also say that ICI and its members stand ready also to help to achieve this, because we indeed have also, of course, experience in the transition to T+1 in the US. And of course it will be hard work, but there is definitely, if indeed the industry works together with the public authorities here, hand in hand, it's something which can definitely be achieved. And if you also look at the data, for example, the benefits in terms of margin savings and the enhanced market efficiency, that makes the effort worldwide. And I'm pretty sure that that success will be seen and that everybody indeed also wants to achieve that. And indeed, working together is the way to do that.
That's a very good word for the end. Thank you very much, Anke, for this very interesting discussion we just had. I would like now to give the floor to Jennifer de Nijs, who is Director for the Development of the Financial Center at the Luxembourg Ministry of Finance.
Thank you, Benoît. Welcome to this session, Will the ESG Backlash Ebb in 2025? I'm here today with Timothée Jaulin, Head of Responsible Investment Development at Amundi. And together we'll be exploring today whether or not there's any new ESG trends for next year and whether the ESG backlash will stay or go in 2025. But before we delve into the future, it's important to take stock and look at what situation we have today. We have had a record peak in 2021 in ESG investments. We have a more serious backlash that has happened in the last 2 years with investor appetite decreasing. Timothée, can you run us through the reasons for this shift?
Hello, Jenny, and thanks, Lux for Finance, for having me here. Look, I'd like to share perhaps a slightly more nuanced view than what you depicted, because it's true that in the industry, and especially in the press, we could read about the backlash. That was the case very much in 2023. But our view at Amundi was that it was much more of a sentiment than a true depiction of what was happening in reality. Because if you looked at a certain number of indicators that we meant to be as objective as possible to really capture the trend around sustainable investment, just for instance, focus at 2023, when remember, we were at the so-called peak of the supposed backlash. Well, if you were looking at fund flows, it was a year of significant net outflows for the industry in general, in Europe in particular. But when you were zooming at the kind of outflows we were experiencing, well, it was minus 76 billion all in all for the entire industry. But then if you were zooming on the most advanced value proposition among responsible investment products, it was a year of significant net inflows of plus 28 billion euros. So that's in terms of fund flows for 2023. Then when you were looking at market performance, because performance matters, right? Well, just looking at the main ESG indices, for instance, if you take as a reference the family of ESG indices of MSCI, back in 2023, it was all in green territories, but in emerging markets, with significant outperformance for the year 2023, and also a positive territory in terms of 10-year long track record versus the parent index. And when you were looking at the level of progress or commitment among corporates, if you just look at one simple proxy that one can use, which is the number of commitments around climate using SBTi framework, we saw a jump in 2023 of plus 67% in a year, again, of so-called ESG backlash. So we were actually in green territory, if you want, in terms of fund flows for the advanced RI proposition versus the rest of the industry. We were in the green territory in terms of financial performance and green territory as well in terms of level of commitment of companies. So yes, there has been, if you want, normalization in terms of fund flows, because we've reached a point where the level of penetration of ESG fund is simply staggering versus where we were 5, 10 years ago. There has been a political backlash, but limited to the United States. But for the rest of the world, we've seen what we call a normalization, because we've reached certain heights. And since then, of course, the fund flows has been in more normal trend than exponential growth as we've experienced over the past few years.
Thank you for that, Timothée. So you are basically saying that a lot of what we've heard in the press the last few years has been more of an exaggeration, but actually the numbers are telling us that there is still very much a lot of investor interest into ESG activities. Maybe to add to that question, we've had some uncertainties in the last few years also on a regulatory front with regards to ESG. So there was this whole topic on fund names with new ESMA guidelines recently having come out. There has been the whole wave of SFDR, companies getting to grips with reporting, CSRDs coming into play. Are any of these changes and also companies getting more used to the reporting that they have to do, will that also have an effect on how much capital flows we will see into ESG coming into 2025?
I guess that is very much the ambition of the regulation since day one. If you summarize, if you want, the ambition of the sustainable finance package within the European Union, you had one primary objective, which was about enhancing market integrity and transparency. But the second objective was very clear. It was about mobilizing capital to support the financing of sustainable development goals and climate objectives within the EU and globally. On the first objective, thanks to SFDR implementation and related regulatory blocks, we've reached, let's say, a certain level of maturity in terms of transparency standards, in terms of reflecting commitments in the fund documentation, in terms of homogenizing the kind of sustainability characteristics that are promoted by fund manager. So there is a lot to do in terms of improving the regulation, making it more efficient, but we've reached a level of transparency and integrity that was unseen before. So I would say from that standpoint, the first objective is at least half met, perhaps not fully met, because simply in our experience, the concepts that have been promoted are quite complex, to be honest, and perhaps a bit too complex to be fully apprehended by the entire value chain in the fund distribution industry within Europe, which is critical if we want to be in capacity to capture, as requested by the regulation, the sustainability preferences of the end savers. And this is a critical component in the capital mobilization objective. Why? Because the prior was that EU savers had a significant level of preference for sustainable products, but they were not able to express those preferences, to translate them into actual investment decision, so that more capital could be mobilized to finance sustainable development. But the reality is that if the sustainability preferences in the context of MiFID II are not well captured, and if you cannot put the right offering in front of those sustainability preferences, well, you are not in capacity to use that saving to mobilize capital to finance sustainable development. So that's a bit the part for now that has been not achieved, we would say, by the regulation, and where probably the existing commission, which is starting to work, should focus its effort on to ensure that we do not end up only in a market with high integrity and transparency standards, but we also have a market that is pretty efficient in terms of allocating capital to support the financing of climate and sustainable development goals in EU, in emerging markets, all these areas where we all know that it's very much needed.
I think you're right. Next year in particular will be extremely interesting to look into the European context because, as you said, not only have we got a new European Commission now, but there will be a review on regulation to simplify them. If we read the Draghi and Letta reports, that's very much a direction the EU wants to go in, and this will certainly impact sustainable finance regulation as well. And secondly, we will have the SFDR review. So there we will actually get the input from the market. And as you said, hopefully this will lead into a regulatory system that will be a lot more practical and less complex. And I think this is what we might be seeing in 2025. But I'll be interested to watch this space in particular. But maybe to move on to trends, Timothée, when we talk about sustainable finance or climate finance, there's two topics that you can't move away from at the moment, and that is biodiversity finance and natural capital. You hear it everywhere. In which sense are these very much trend words, or are there really many products that are on the market right now and a lot of investor appetite for these types of products? Can you run us through that? And tell us what you think, how the space will look on these topics in 2025.
Well, these are clearly top of mind when it comes to hot trends in sustainable finance in 24, but clearly to stay in 2025. But these are not just cyclical trends. These are not just hypes. Because we believe they are associated with what we call the secular trends in the sustainable finance world. And the perhaps primary reason for that comes from the fact that companies are already experiencing the physical implications of climate change and of the fact that they need to operate, they need to manage their value chain in a planet that is more and more exposed to what we call planetary boundaries. And within these planetary boundaries, of course, you would find climate change, but you would also find topical issues such as biodiversity, land degradation, and so on and so forth. And companies are already feeling the heat to a large extent, especially in the sectors where they have to secure, if you want, a sourcing of products and goods from areas where they need to make sure that it's not exposed to deforestation. They're able to match, if you want, the sustainability characteristics that they want to embed within their production process. They want to also comply with human rights expectations and so on and so forth. And so that's, I think, the primary reason is that for companies, a lot of people think that this is an emerging team, this is a nascent team. I would say that's not the case. In many industries and sectors, biodiversity risk, the risk linked to natural capital degradation, and the risk linked to value chain in general, linked to climate change and nature, are very critical, and they're front and center in their long-term resilience plan. So I think the primary factor is the fact that it's highly material for corporates. The second factor is that we have now, let's say, a better defined global framework with specific objectives attached to it, notably thanks to the COP that took place in Kunming and Montreal. And that, if you want, enable corporates, economic actors, as well as investors from both the public and the private side to identify investment opportunities that are supportive of these goals. And the last, of course, criteria within that trend is the fact that we see more and more opportunities emerging that are economically viable, which is, as you know, a critical factor to mobilize capital, to create funds, and to manage portfolios. And that's the reason why we're seeing as well, not only funds on the listed space, which are selecting companies that are faring well vis-à-vis biodiversity risk and opportunities. That's one trend in terms of fund development, but we are seeing as well more and more impact products, notably in the real asset space, which are linked to a nature-based solution, for instance, regenerative agriculture, for instance, funds that are working on land restoration, funds that are also aiming to generate carbon and biodiversity credits, and so on and so forth. And so they are benefiting, if you want, from this new opportunity space, which are linked to economically viable opportunities that are beneficial to biodiversity objectives.
Thank you for that. And maybe to add on to that, you mentioned the biodiversity COP. We actually had 3 COPs this year. We had the climate COP, the biodiversity COP, and the COP on combating desertification, which deals with land degradation. Aside from the biodiversity COP, which you've covered, are any of the outcomes of the negotiations of these other 2 COPs have any outcomes that could be interesting for the markets, anything that could also help mobilize capital in these areas?
I would say there was probably 2 key takeaways that we think are highly relevant for investors. Number 1 is the adoption of the so-called Article 6 during the COP in Baku, the COP29, which is setting a framework at the macro level. It's a very macro framework between sovereign to work on a compensation program, notably using carbon credits, or at least carbon offset mechanism. And we believe this is a potential way, of course, to mobilize money, to mobilize capital, to show also some solidarity to enhance the level of financing in the South towards climate mitigation and adaptation. But this could have a ripple-down effect at the level of corporates or at the level of investors, to the extent that, as you may know, there are many funds in the impact space, notably in emerging markets, that are, or whose value, if you want, or whose financial performances are partly linked to their ability to extract value from the fact that they enable to avoid carbon. So they sell credit or they sell their products or goods at a higher price thanks to carbon insetting. And this mechanism is very important to provide a certain level of comfort and confidence in those mechanisms. And we've seen interesting signals as well in Cali, with a first declaration on the use of biodiversity credit with a proposition in terms of what good standards could and should be. And this is, of course, a conversation that will be continued in the year ahead of us, notably to prepare the COP that will take place in Brazil. So credit, both on the carbon side as well as on the biodiversity side, there was a very important development in both biodiversity and climate COP. The second key development was a reaffirmation of the financing objectives with the newly quantified climate goals, and of course, additional financing objectives and commitment on biodiversity in Cali. This is not having an impact on its own on investors, but of course this will go through, to a certain extent, a development finance institution, ministers of development. This will go through multilateral development banks, which all have set at their level private capital mobilization objectives. And thanks to these additional objectives and commitment, we expect to see increased activity in blended finance, in private-public partnerships that will aim to create investment products with appealing financial features and, of course, appealing impact features, to mobilize additional capital from the private sector. And we certainly think that private investors should monitor that space very closely.
Thank you. And I think maybe to conclude also the session here, I think we can see a lot of positive potential for next year. There's more regulatory certainty. There's momentum coming out of the COPs, as well as the new European Commission, as well as normal market conditions, such as interest rates going down, inflation going back to normal. I think all of that is a more conducive investment environment in any case. And I think, Timothée, you and I, unless you disagree with me, but I think we can agree that 2025 is definitely going to see an end to the backlash of ESG, even though I think you showed us with your numbers that we never were in a bad situation, at least in Europe. And I think we very much look forward to 2025 and see where ESG world is going to take us. And thank you, Timothée, for taking the time to be with us today. And with that, I will hand over back to you, Tom, for the concluding remarks.
Thank you, Jenny. So that concludes this morning's conference. I want to take this opportunity again to thank our moderators and especially our speakers for their fantastic insights. I'm pretty sure that this edition will get a lot of replays afterwards. Thank you also again for our sponsors. As this was our last digital conference for this year, I also want to thank my team at LFF for the fantastic work, not only on this edition, but all the other digital conferences that we have organized over the year. And we will, of course, see you again in the new year. In fact, on February the 5th, we will have the next edition of Focus On, and this time on the new EU Commission agenda. So in the meantime, I will wish you happy holidays. Thank you, and see you in the new year.